Good morning, Shantanu here, and welcome back to my channel. I'm so excited to share something very, very valuable with you today, and that really has transformed the way I look at stock market investing. A few years ago, I was just like many of you, throwing darts at stock picks, getting caught up in the latest hot tips, and frankly, not sleeping well at night because I really never knew if my investments made any sense, whether they were built on very strong foundations. So then I started researching a lot of legendary investors, tried to understand their frameworks and the way they look at investing in a company. And then that really made an incredible difference in how I look at companies. And this particular approach is a systematic approach, that legends like Warren Buffett, Benjamin Graham, Peter Lynch, they use. So basically what it guarantees you that you can now sleep peacefully knowing that your every single hard-earned rupee in your portfolio, whatever you are investing, has passed through multiple layers of rigorous analysis. And that's why today I'm sharing with you this very powerful four-step ultimate stock analysis framework. And this is the exact system I use to find really hidden gems in the market. And the best part is I'm going to walk you through every single step. So at the end of this video, you will have a very clear roadmap to analyze any stock like a pro. And this is the kind of framework I'm looking for. And as you can see here, I will dwell a bit into the philosophy. Then there is a layer one, layer two, layer three, layer four, and then the final step, which is constructing your very powerful portfolio. So please grab a coffee, get comfortable, and let's dive in together. Now, why this framework really changes everything. So before we jump into the layers, let me share you the philosophy that really makes it work. And this is the basic philosophy here, which is like, this is based on you have to emulate the greats. Basically, it focuses on Graham's discipline value. It focuses on Warren Buffett's obsession with quality and moats. It also takes into account Peter Lynch's eye for growth. It focuses on Greenblatt's mechanistic brilliance, and then it combines everything from all these greatest investors into a beautiful, scalable process, right? So this is basically the philosophy behind this very, very powerful tool. So let's look at the layer one, which is the which is the first layer, which is based on Graham and Greenblatt. And the objective is to scan the market for really cheap, profitable, and growing companies. And this is very, very important because when it comes to value investing, you invest in a company who's based on all the important ratios. You know that maybe it is not really trading well. That's where you create a leverage, and that's what makes this particular thing very, very powerful. And then of course the execution is based on any stock screeners. Okay, you can go to screener.in, Trendline, Bloomberg, etc. You can screen all the stocks, and then we use a screening criteria which is basically based on valuation, profitability, financial strength, and growth. So in valuation, we are looking at a PE ratio of less than 18, a PB ratio of which is higher than 2, PEG ratio which is higher than 1.2, and the dividend yield has to be greater than 2. So these are the most important factors when you are looking at valuation of any company. Then the second we look at is whether the business is really good in terms of profitability and quality. And that's why we use the ROE, which has to be higher than 15% consistently for 5 years. And then we also look at ROCE, which has to be greater than 18% consistently for 5 years. So what you're actually doing is you are doing a very, very rigorous analysis. And if you are analyzing, say, 50 companies, when you start doing this analysis, you are actually pinning, like, every step will reduce the companies who are not able to make sure that they are able to fulfill this criteria. And then you look at the financial strength, how safe is the business. And here we look at the debt to equity ratio, which has to be greater than zero point 0.6. And then the interest coverage ratio, which has to be higher than 4. And the last test for this is what is the 5 years EPS CAGR, and it has to be higher than 10%, and 5 years sales CAGR, which has to be greater than 8%. So you can now see how powerful the first step is, in terms of how we are, the first layer of how we are valuing the business. And as I said, this is based on the uh, uh, Graham and Greenblatt framework. Then this you, I'm sure you are terribly impressed by what you saw right now. But then this doesn't end here. We are looking at then the second layer, which is using the Petrosky and the Greenblatt, right? So in the objective of this particular thing is to eliminate any value traps, identify improving fundamentals. Execution, we have to calculate scores for layer one stocks, and then we have to apply the Piotrowski F score, which is at a 9-point scale, which looks at the profitability, leverage, liquidity, efficiency, and all those kind of things, right? So, is the company having a positive net income? Does it have a positive operating cash flow? Does it have higher return on assets? And whether their OCF is higher than their net income. Then we also look at the liquidity scenario. Do they have low debt? Do they have a higher current ratio? And if there is no dilution, right? And then we look at their efficiency. What are their margins? What are their turnovers, right? So do they have higher gross margins or higher asset turnover? So this is the rigorous step number two, which really makes sure that out of 50, perhaps you will then get at just 5 or 7 stocks which will pass this particular test. But then that's not all, because you really want to find a couple of really great winners which you can hold and just sleep like a baby. So let's look at, so that's why we apply the layer number 3, which is the intrinsic value X-ray, which I've created based on Warren Buffett and Charlie Munger's frameworks. And here the objective is we determine the intrinsic value and the margin of safety. We use the discounted DCF analysis, the discounted cash flow method, and the process is very simple. We look at what are the what kind of free cash flows these companies are going to generate in the next 5-10 years. Calculate the terminal value, that is the perpetual growth. It has to be 3-4%. Then we determine the discount rate. Then we calculate intrinsic value, discount FCFs, and terminal value, and then determine the margin of safety. It has to be higher than 25%. So the beauty is that this is not a quick rich scheme, but really a very, very powerful framework, which allows you to really pick up the best stock. And then that's, once you are there, I think you'll be left with only 3 or 4 companies. And that's where the layer number 4 kicks in. And this is about the qualitative analysis. You have to understand their story, what is their competitive advantage, to build conviction. So you have to go through go and do some deep research on the company, their founders, all those kind of things. Then we read all the annual reports for the last 5 years and look at their industry reports, earnings calls, etc. And then we look at the 4 most important things here. The economic moat, what is their sustainable competitive advantage, right? So what is the brand power? For example, in India, if you look at Asian Paints, it has got a tremendous brand power. Or do they have a cost advantage? Let's look at like something like DMart. Then we can look at, are they able to switch costs? So these are all competitive modes. Very, very difficult for any company, other competitor to copy this. These are the switching costs. Or there can be network effects, which is like Bajaj Finance, because they have sold millions of scooters. and for them to get data of their customers is extremely easy. And then we look at regulatory licenses, because that can also be a mode. For example, PVR Inox, they have a license, and not everybody can actually operate those. So this is the economic mode what we look at. Then we look at the management quality and capital allocation. So what is the capital allocation? ROIC, which has to be higher than WACC. The integrity, we have to look at whether the directors, do they have any cases filed in court, all those kind of things. Are they transparent? All those kind of things, and the skin in the game. So this is very important, that are these guys holding a lot of percentage in the company? Imagine there is a company and the founders are only holding a very less amount of equity in the company. That shows that they are not confident, right? So these are them. Then we look at the industry analysis, the tailwinds, so what is the growth, industries growth, stability, decline, using Peter Porter's five forces. And then what are the benefits of bigger secular trends, So we look at the larger picture, and then we also look at the ESG and security risk pertaining to the regulatory environment, all that kind of stuff. So once you have these four powerful layers, only then you can actually pick up very, very powerful stocks. And then you have this complete checklist, So before you buy anything, we make sure whether it's a wonderful layer. We look at whether their fundamentals are improving, whether we are getting this at that particular stock at a significant discount to its actual intrinsic value. And then we are shortlisting the stocks based on disciplined process, which is layer number one. So layer number one, layer number two, layer number three, and layer number four. These four layers, if you follow this particular system, you will be like the top notch analysts, just like the Blackstone guys or the Merrill Lynch, really top level kind of fund managers who are investing money. And the beauty of that is this entire framework is based on, it is not based on emotions. It's based on very, very strong financial fundamentals. And the weights are based on margin of safety and moat strength. So basically what I'm trying to tell you is, don't get into stock market for buying stocks for a day or two or a month. No, that's not the game. You need to pick up winners and buy stocks and just forget about it for at least 5 to 6 years. That's where the game changes. And this entire framework is very exhaustive, it's very systematic, and it's basically crafted for very elite level investors. And it ensures a very, very deep margin of safety and a profound business understanding of all this particular, of how do you actually measure the quality of the company. And that's why I think these four layers, the qualitative sieve, which includes Graham and Greenwald, the financial health and momentum scan, and the intrinsic value X-ray, and then quantitative and qualitative deep dive. These are the four frameworks which really make this system very, very powerful. And I hope you like this particular video. And if you like it, if you want to learn more about investing in high value companies, then please feel free to get in touch with me, and I will see you in the next video. Thank you.